good afternoon, and welcome back, everyone, to our third session, which is actually session number 2 of how to grow your trading account, where we focus on risk management. This is really where we focus on kicking off your 2024 and making sure that you have the tools, you have the education to put you onto the path towards profitability. And in session 1, we really focus our attention on understanding how our emotions affect our behaviors that contribute to underperformance of our portfolios. And today we're going to break that down further. We're going to look at 2 key components in session 3 and session 4. Today we're going to focus more so on the loss side of things that cause us to underperform in our portfolios, specifically why losses end up typically larger than we plan on our trades. And we're going to talk about why that happens and what we can do to combat that. Now, the great thing about today's session is that everything is going to be fairly black and white. The rules that you're going to learn are very simple to understand, simple to implement. They may be difficult to really wrap your head around and really get into to implement them, but the rules themselves are incredibly simple, so easy to understand. So let's go ahead and get started. Now, just for those of you that are new to OptionsPlay, we host these sessions every single Thursday afternoon, our OptionsPlay education sessions, and our sole focus, our mission here is to empower you to trade sustainably and confidently. Every single Thursday, we are here to help you understand how to better yourself as a trader. And today we are focusing, or rather the month of January, we're focusing on the aspect of trading education that I think is most often overlooked by most traders, not because you don't want to focus on it, but because naturally there's just not a lot of education on it, which is the behavioral side, the risk management side, the position management side of things, how that greatly affects your profitability. I see too much education on technical analysis, fundamental analysis, option strategies, not enough on this. So I'm really focusing this the start of 2024 on this incredibly important aspect of your trading education to put you onto that path of profitability. But before we get started, what we are going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any of the specific securities that I'll be using as example purposes during today's session. So I'll kick off by just reviewing what our goals for this January summit is going to be. And now what we're going to break it down is, what does it take to grow a trading account? We're going to talk about wins and losses, but like I said, today we're going to focus more on the loss side of your portfolio and how that contributes to underperformance and profitability. We're going to talk a little bit about the trading game. It's important to understand what game you're playing in order to play the game correctly. And a lot of you think we're playing a different game than the actual game that we're playing. And once you kind of realize that, that's when the light bulb really clicks for many of you who either have learned this in the past or have learned sessions with me in the past, or if this is your first time, this is the light bulb that hopefully clicks for you, that gets you to think about trading and losses in a different way, that helps change your behaviors and switches you towards thinking about the right mindset and the right path towards profitability. We'll talk about the rules of that trading game and some of the daily the signals and process that we have here. And ultimately, we'll end this with a question and answer session here at the very end. But the primary thing that I want you to be able to walk away from today's session is a clear understanding as to what risk management techniques can you deploy to ensure that your ability to grow your trading account in the long run. Or rather, I think another way to word this is, what risk management techniques can you deploy to ensure that you don't underperform, that you don't blow up your accounts, because that is what I see most common in my 18 years as a market strategist, working with thousands of retail and institutional investors. Where do trading accounts go wrong? And most of the time it goes wrong on the risk management side, on the downside, when losses become too large, when losses become impossible to overcome. And today we're going to talk about the math behind it and why it's so black and white, and why it's actually incredibly easy to avoid if you think about it the right way. But most of us don't think about it the right way, which is why it's so difficult to actually implement some of these really simple rules that can help you prevent underperformance in your portfolio. Now, I see a lot of you have already chimed in into the chat window. Most of you have joined us here before that you have chimed in. If you're joining us today for the first time, please feel free to bring up your chat window. Let us know who you are, where you're from. As you can see, we have attendees from just about everywhere around the world. Canada, obviously quite a bit in North America, but I'm seeing Copenhagen, I'm seeing quite a few other countries joining us here today. So please, if you're joining us for the first time, feel free to chime into the chat window. As you can see, there are hundreds of you here learning the same thing. And I'm so glad that many of you are here today because, like I said, this is arguably the most important lesson for traders to learn if you want to put yourself onto profitability. Okay. Now, let's kind of kick off by addressing one question that I get across all of these sessions, which is, can I get the recording and the slides for these sessions? And the answer is yes. We record these sessions. We give you the slides to all of our members and anyone who has access to OptionsPlay completely free of charge. If you don't have an OptionsPlay account, you can sign up for a free trial by following the link in the chat window that Philip is going to post into the chat window, or you can put your phone into the QR code, which points you to optionsplay.com/sign up. I'm sorry, it should be OptionsPlay sign up, not OptionsPlay /grow. I apologize. So Philip has got the right link in the chat window. That will give you a 30-day free trial to the OptionsPlay platform, which will give you also access to everything that I'm going to show you here in terms of tools, but as well as the recording and slides, which we send out over the weekend after each of these Thursday sessions. So if you want access to the recording and slides, which I find is going to be incredibly important, especially for these sessions, because what you learn in these sessions takes time to internalize, and it takes some time of self-reflection. Sometimes after you listen to the webinar, you watch the recording, go through the slides, that's really when you're going to find your ability to have all of this click and actually think about implementing it for your portfolio. Okay, so let's quickly just review, what I see as goals for this session. First of all, our goal is to empower you to grow your trading account and become a profitable trader. That's as simple as our mission for this trading summit. We want to make sure that you have the tools that put you onto the path of profitability. Now, how many of you here? There's a few hundred of you here in this session here today. How many of you are currently struggling to get yourself to profitability in trading? If you are, please type yes into the chat window. If you're struggling to get yourself onto the path of profitability from trading. Okay, I see a lot of yeses. And this is pretty common, in my 18 years of working with traders, of just seeing so many traders. And many of you, despite saying that you're struggling with getting to profitability, have probably spent months, years, potentially thousands of dollars to learn how to trade, right? Whether it's technical analysis, whether it's fundamental analysis, whether it's option strategies, whether it's services where you follow someone else to trade. If that resonates with you, where you feel that you have spent an enormous amount of energy, money, time on learning how to trade, yet you're still here, please type 1 into the chat window. It's not just, hey, I just started yesterday, so I'm struggling right now. I haven't just gotten to it, but many of you have spent countless hours, time, money, different techniques, different services to hopefully get yourself onto the path of profitability, yet you still find yourself in this position. And this is really why I keep going back to traders and saying, it's not your knowledge that's holding you back. It's not that you don't know enough technical analysis. It's not that you don't know enough options strategies. It's not that you don't have access to some secret indicator or some secret strategy that someone else has, that profitable traders have access to that you just don't. Because if that was the case, then all of you that have spent that time and effort and money on signals and indicators, you would be profitable. Yet the vast majority of clients that I work with that have gone through that still have not reached profitability. It tells me that those are the things that are not what's going to contribute to profitability. It's something else. And that something else is something that's not commonly taught. And we'll talk a little bit about why, but that's why I'm here to teach that something else. That's why I'm here to talk about that something else, because that something else is what contributes to the difference between profitable traders and unprofitable traders. So let's talk about two things that I'm going to try to help you build. Number one is confidence. Understand how your emotions influence your behaviors that contribute to wins and losses. Specifically, behaviors that make your wins smaller than you anticipate them to be, and behaviors that cause your losses to be larger than that you anticipate to be. Because we all plan to have small losses and bigger wins, but for some reason, at the end of the day, when we tally everything up, our wins end up being smaller than we think, and our losses always end up somehow being larger than we think. And that is a big part of why we lack the confidence and the ability to trade in the markets. The second thing is building consistency, the ability to stick to a plan regardless of the current market conditions and current open position. Because what happens is that we have a plan, but once we have a winning position, once we have a losing position, and we're seeing the P&Ls tick in our portfolios, something takes over from an emotional perspective, from a behavioral perspective, from our trading plan. And that is when we almost always deviate from our trading plan. And what happens is very simple. Our wins that we think is going to be this big, or a plan is going to be this big, ends up being smaller. And our losses that we plan are going to be this small end up being this large. Okay. And if any of you can also relate to that, please type 2 into the chat window. Perfect. Okay, so we're going to talk about this. And today we're going to focus on one side of it, and the next session we're going to focus on the other side of it, okay? And we're going to focus on the easier, rather simpler side of things today. So what does it take to grow an account? It's actually arguably incredibly simple, right? You need to have consistently where your total wins weighs your total losses. That's it, right? It's a really simple mathematical arithmetic equation. Total wins has to be larger than total losses over whatever period of time you look at in order to reach profitability. So in theory, it sounds really simple, right? But like I said, what ends up happening always is that our losses end up being bigger than we expected to, and our wins typically end up being smaller than we would like them to be. So today, what we're going to focus on is the loss side of things. Next week, we're going to focus on the winning side of things, because the behaviors that we have with each side is different, and I want to tackle each one separately. So today, we're going to talk about why our loss is larger than we anticipate them to be over the long run, and what we can do to combat that and avoid some of those things. So generally speaking, there are two things that contribute to losing that confidence and losing your ability to feel that you are onto the path of profitability. Number one is big losses, meaning you have a loss that's so large in your portfolio that you've blown such a huge hole in your portfolio, it's very difficult to come back from without either redepositing more money into your trading account, or now you're forced to trade considerably smaller position sizes than you were originally trading. And that makes it incredibly even harder to get yourself back to where you were and back to profitability. So the emotions that lead us to hang on to losers for longer and adding on to losing positions, those are the things that typically contribute to big losses. So you say, hey, I put on this position. If this trade goes, to a certain point, I'm going to cut my losses and move on to the next trade. What happens? The position moves against you. What do? You don't take that loss, right? You don't say, I'm going to take that loss. You still hope that that position is going to come back. So you say, I'm going to hold on to it for one day longer, or, a few days longer. You basically kick the can down the road because you want to avoid the pain of taking that loss today. And what ends up happening, occasionally that trade does end up working in your favor and you kind of get back to break even or maybe end up even with a win. But more often than not in the long run, the problem is that the behavior that you have of deviating from your trading plan, if you keep deviating from your trading plan, your losses will end up being larger than you anticipate in the long run. Now, I'm certain that most of you can relate to that. Please type 3 into the chat window if that makes sense to you. Now, that is one of the most common, I would say, traits that we see traders have with regards to why losses end up being larger than they should. The second thing is arguably, it's more damaging, but arguably more active and actually speaks to, investors who are quite smart, who are trying to do something, but end up hurting themselves even more in the long run, which is adding to a losing position. Meaning, you think a stock is going to go higher, so you have a long position, but instead of the stock going higher, it ends up going lower. So what do? You, instead of just saying, oh, I'm going to hold on to it, hope that it gets back to break even, you now add more exposure. You buy some more. You're thinking to yourself, okay, it's so oversold now, it's got to bounce. And even if it bounces a little, because I bought more, I'll get myself back to break even faster, right? Now, this is actually active. This is you actively doing something about the losing position. And the interesting thing from a psychological perspective is that in all other aspects of your life, when something goes wrong, what do? You take action. You say, hey, something's not going in the direction I expected to. Let me do something about it. Whether it's professionally at work, whether it's in your personal life, if something is not going in the direction you expect it to, you do something about it. You get your partner, you get your colleagues, you get your friends, whatever it is, you do it yourself. You try to fix the problem, right? And that's good. That's a good thing in every other aspect of your life. When things go wrong, you actively try to fix it. But the problem is that in markets, you can't fix a trade that's not going in the direction you expect it to. If you think Apple stock is going to go up, but it's going down, there's nothing you can do to fix Apple stock going down. And that is the fallacy that we have from other aspects of our life, where we can fix things that we try to apply to trading that ends up actually hurting us more in the long run. Because inevitably what happens is that once, twice, 3 times, sometimes this strategy works out, but you're always going to have a time where this strategy, instead of bouncing higher, it ends up continuing going lower. Maybe you add some more and the stock continues to go lower. That's really where you, instead of risk, maybe $2,000 in the first trade, and you said, I'm going to lose $2,000. By the time you end it, you're down $10,000 in your trade. This is less common, but actually still fairly common in traders. And if you can relate to that, please type 4 into the chat window, where you actively think you're fixing the problem, but by actively fixing the problem, you're actually making it worse. And again, psychologically, it's because we do this in every other aspect of our lives, because generally speaking, we can fix a lot of things in our lives. But unfortunately, when the stock is not going the direction you expect it to, you're not going to be able to fix it. And that fallacy that you think you can fix it is what contributes to having these huge losses in your portfolio, okay? So big losses is a very, very large contributing factor to why people underperform or don't find themselves capable of getting themselves onto the path to profitability. Now, we're going to talk about how to fix this in a second, okay? The second thing is consecutive or consistent losses. This is really where emotions lead us to give up on a strategy and move on. What do I mean by this? Maybe you subscribe to a service, maybe you learned a new strategy, and now you're starting to trade that strategy, you're starting to implement that strategy. And inevitably, maybe it goes really well the first couple of months, and all of a sudden you come across a string of losing trades. 5 losing trades, 6 losing trades, 7 losing trades, right? Whether it's an overall strategy that you're following, whether it's a signal service that you're subscribing to. And what happens is that you have a string of losers and you start to lose faith in the strategy. And this is really the other aspect of our emotions that we have a really tough time dealing with, is consecutive losses, right? You might have signal services or strategies that claim 60, 70% winners. So how do you have 7 consecutive losing trades in a row? Well, this is really where, if you look at the mathematics behind profitability in the long run, that's exactly what it is. It's profitability in the long run. It doesn't mean that in the short run, you won't go through pain, that you won't suffer through losses. And anyone who's profitable in trading knows that consecutive losses happen, and your role as a trader is not to prevent it. Your role is to survive it. And we'll talk a little bit about how to survive it, because no matter how great your strategy is, you're going to always come across a string of losers. So again, your role as a trader is not to prevent consecutive losses. You can't prevent consecutive losses. It's like flipping a coin. You know, flipping a coin has a 50-50 shot of heads or tails, yet it's very common that you're going to see a string of 5, 6 heads or tails in a row. And what you have to do as a trader is you can't avoid it, but you have to know how to survive it. And that's really the mindset that you have to take with trading. And this is something that we're going to tackle here in the next slide, which is a concept called infinite versus finite games. So before, at the very beginning, I said trading is a game. And you have to understand what game it is in order for you to play that game and play it well. Okay. So in the 80s, there was a NYU professor who wrote a book called Finite versus Infinite Games. And he was actually a religious philosopher. He wasn't a business executive or a trader. He was a religious philosopher, but he wrote this book called Finite versus Infinite Games. And in the book, he theorized there's two types of games in the world. There are finite games and there are infinite games. Finite games are games that have fixed rules. The game ends at a certain point, and based on those rules, when the game ends, you declare a winner or a loser. And the goal when you play a finite game is to simply win at that game. A good example of this are basketball, football, chess. These are all games that have fixed set of rules. The game will end at a certain point, and based on the rules, at the end, you will declare a winner or a loser. So when you're playing basketball, you're playing chess, you're playing football, what you're wanting to do is you want to win. That is your goal, and you want to do everything at all costs in order to win. So that's a type of game that we're all familiar with. And that is a game that we sort of resonate with when trading, right? Because there's a lot of wins and losses. You think about win rates and winning, and you would think that when you're trading, the goal is to win. Yet there's a second type of game that he theorized, and he said there's infinite games. In an infinite game, there are no agreed upon rules. In an infinite game, it never ends, and there's no such thing as winning or losing. There are either players in the game or dropouts in the game. And a good example of this is running a business. Think about running a business. There are no rules to running a business. It never ends in terms of running a business. And you either are in business or you are out of business because you no longer have the resources to stay in business. And when you're playing an infinite game, your goal is not to win. There's no winning in an infinite game. Your only goal as an infinite game, playing an infinite game, is to continue playing, is to make sure that you have the resources to continue trading. And a good example of this, a good parallel to this, is actually trading. Because when you're trading, one, there's no agreed upon rules. Trading never ends. It always continues on. And your role as a trader is not to win at trading, because there's no such thing as winning at trading. There's you can win one trade, but that's not what you're here to do. You're not here to win one trade. You're here to win long term, which is, or rather in the infinite game, which is your goal is to stay in the game. Your goal is not to win. Your goal is not to lose. Your goal is to stay in the game. And that is a fundamental shift to how you think about trading, because many of you think about trading as trying to win. But if you think about it, there's no such thing as winning. Making money is not winning. Your goal is to make sure that you continue playing. And most of you fail at that mindset of continuing playing. And because you think about winning and losing, what ends up happening is that you're effectively playing the wrong game, and you're having the wrong mindset to how you're approaching the game. And having the wrong mindset is what contributes to us continuing to think about wins and losses and wins and losses. And that's not what you need to be focused on. Your focus is on continuing to play. And what does it mean to continue to play? What it means to continue to play is basically don't blow up your account, right? Just like how when you're running a business, it's basically saying don't go out of business. Don't basically have too many expenses that outweigh your profits that you have to basically shut down or declare bankruptcy of your business. It's the same concept with trading. And when you think about it from that perspective, that your goal is to continue trading, now your priorities and what you do in terms of just what your priorities are and how you think about each trade changes. And this is the light bulb moment for traders that you have to go through if you want to get yourself onto profitability. And I would say when you're first introduced to this concept, you understand the words I'm saying, but you don't understand it internally yet. And it takes time to reflect and it takes time to really internalize this before it makes sense to you that, oh, trading is a completely different mindset than winning and losing, because most of us, when we first get into trading, we're stuck in this win versus loss mindset, which is a finite game. We're not playing a finite game. And when you're playing an infinite game within finite game mentality and finite game rules, you end up being a loser in the infinite game, or the person who goes out of business, or the person who blows up their trading account. And there are so many different parallels of infinite games in your life. Your marriage, running a business, trading. These are all infinite games, and you have to approach them in a very different way. Like, think about if you approach your marriage as just wins and losses, like, arguments that you're winning and losing. If you think about your marriage as winning and losing, guess what? You probably won't stay married for very long. Same thing with running a business, and same thing with trading. And that is the mindset change that you have to make. And like I said, easy words to understand, very difficult to internalize sometimes. It takes some time to kind of do that introspection and that reflection to understand what that really means of focusing on something different than winning and losing. Okay, so let's talk about how to actually achieve this, right? And what are some of the rules that you can apply to actually think about that infinite game? And like I said, when you play an infinite game, your goal is to stay in the game and make sure that you don't drop out. So how do you make sure you never drop out? And this is really where we have a very simple rule to help prevent you from doing this. And that's the golden rule of trading. Now, the golden rule of trading is very simple. Never risk more than 1 to 2% of your entire portfolio on any given trade, which means that if the trade that you are currently placing goes completely south in the opposite direction that you expect it to, that should never wipe out more than 1 to 2% of your total portfolio value. That's how you sustain continuing to play, because no matter what happens, no single trade, no single event, no single bad luck will cause you to basically blow up your account and cause you to go out of business or blow up your trading account and not be able to continue playing the game. And this has a few different important aspects. Number one, small losses are just simply easier to let go of and accept, right? So you risk a small percentage of your portfolio and the stock that you thought was going to go up goes down. Guess what? You've lost a small percentage of your portfolio. You're not as emotionally attached to that one idea or that one trade. You're not monetarily attached to that one idea or one trade. And you simply are going to be able to let go of a loss much easier when they're small than when you have, let's say, a trade that's risking 10, 20% of your total portfolio. If you have a trade that's riding, that 20% of your entire portfolio is riding on one trade, guess what? You're going to be emotionally and monetarily tied to that trade. And you're going to have a very, very difficult time to let go of that loss if it does start to go against you. Does that make sense, everyone? Please type 5 into the chat window if that makes sense to you. And there's a lot of math behind why 1 to 2% is the rule. And even when you go from 2 to 3%, the risk of you blowing your account grows exponentially. For every 1% more you go in terms of risk, the probability of you blowing up your account grows at an exponential pace. So 1 to 2% puts you basically at that lower end of the curve. So your probability of blowing up your account for every 1% you go doesn't grow linearly, it grows exponentially. So what we're trying to do is make sure that you stay on this end of the curve so that no matter what happens, even if you have a large number of losers, you're able to survive that. Before, I talked about consecutive losses. You're always going to come across consecutive losses as a trader, even if you have a strategy with a relatively high win rate. And that's the fallacy of high win rates. A lot of people think that, oh, if I just have a strategy with high win rates, I won't lose, right? But that's the problem, is that you have high win rates. A lot of times people who have high win rate strategies end up risking a large percentage of their portfolio. And what happens is that once in a while, you're going to come across these strings of losing trades. And what happens is when you risk too much of your portfolio per trade, you come across these strings of losers. You now have blown up such a large hole in your portfolio, it becomes very difficult to come back from, and you're no longer surviving. And you're not thinking about playing the game, you're thinking about winning. And once you think about winning and losing, that's when you've lost sight of the real goal of trading. And that's when you have the highest probability of blowing up your account. Okay, so the win rate fallacy is really the probability, what is the probability of having 7 losing trades in a row if you have a 50% win rate? Now, this is a bit of a thought experiment. And some of you might have preconceived notions as to, what are the chances of having 7 consecutive losing trades if you have a strategy that has a 50% win rate? The answer can have a significant impact on how you view a string of losses, right? A lot of times I'll see people will say, under 1% chance of having 7 consecutive losing trades in a row. It's basically saying, what are the chances of having 7, because you have a 50% win rate? That's basically like a coin toss, right? A heads or tails coin toss. What are your chances of having 7 heads in a row or 7 tails in a row? A lot of people tell me, well, it's under 1%. So the chances of that happening are so low, I'm not too worried about having 7 losing trades in a row. But the reality of it, if you're trading actively, is that in any given year, with a 50% win rate, you have a close to 50% chance that you're going to come across 7 losing trades at some point throughout that year. Meaning, if you just flip a coin, because you're trading all year long, you're not just trading 7 trades and stopping, right? If you're just trading 7 trades and you're stopping, yes, the chances of having all 7 trades losing is under 1%. But you're not just making 7 trades and stopping there. You're making perhaps hundreds of trades a year. And when you make hundreds of trades a year and you're flipping a coin every single time, guess what? At some point throughout the year, you're going to have 7 losing trades in a row. So you have a 50-50 shot. You basically have a coin toss shot. In 1 year, you're going to come across at least one time of the year where you have 7 losing trades in a row. And the question is, does your risk management strategy allow you to survive that? If it doesn't, then you are very likely, you have a 50% chance that you're not going to be profitable this year because you don't have the proper risk management techniques to survive 7 losing trades in a row. But if you follow this type of golden rule of trading, where you never risk more than 1 to 2% of your total account value in trading, and you come across that 7 losing trades in a row, guess what? You're going to survive it and you're going to get past it. And that is how you get yourself onto the path of profitability that most traders, when you think about only wins and losses and you're not thinking about the long term, you fall into that fallacy and you end up in that trap of losing, losing big at some point throughout the year. You lose faith in that strategy. You basically jump ship and you cancel that service. You subscribe to some other service, hoping that some other service won't have 7 losing trades in a row. But somehow, yet sometime down the line, that's going to happen again. You're going to fall into the same pattern over and over again, no matter what strategy you look at, no matter how you use the markets, no matter whether you're using technical or fundamental analysis, what type of options trading you use, you're going to come across this. And if you don't think about this properly, you don't plan for it properly, you're just going to repeat this cycle over and over and over again every single time because you're not focused on surviving the consecutive losses. You keep thinking somehow there's some way, there's some magic strategy that will avoid the 7 losing trades in a row, and as long as I find it, I'll be profitable. But that's the fallacy that most traders fall under. Can you relate to that? Please type 1 into the chat window. If you find you keep going from one strategy to the next, and you keep coming across where you think that it's working, all of a sudden you have these string of losers, and you say to yourself, this is a terrible strategy. I've lost faith in this. Let me try something else. And my advice to you is that there's probably nothing wrong with your strategy. It's just the problem is how you're thinking about it and your mindset, that somehow some magic profitable strategist is not going to have losing trades in a row, and that's just not going to happen. It's always going to happen. It's just a matter of when, and your role as a trader is to make sure that you survive it, not avoid it. If you're trying to avoid it, then you're going to keep repeating the cycle over and over and over again. But if you think about, hey, how do I survive it when it does come? That is when you're going to start putting yourself onto that path of profitability. Okay, so just to reiterate, successful traders, it's never due to some kind of strategy or indicator that somehow they have access to that you don't. Because if that was the case, then all of you that have spent all this money on different strategies and indicators would be successful already. But that's not what differentiates it. What differentiates successful traders from everyone else is their ability to follow a trading plan and consistently regulate their emotions, especially during a loss. Now, like I said, when you trade small, losses are much easier to deal with and accept and move on from, right? When you trade large, that's when you have that, what poker players call pot committed. You basically have risked so much money that you can't fold. You can't basically accept the fact that you might lose and walk away from the trade. You basically step into it and you hope, and the only thing you have is hope. And occasionally that works, but there's always going to be a time where it doesn't work and you end up blowing up your account. So successful traders, what they're better at doing is not trading. What they're better at doing is following their trading plan and regulating their emotions, and know that they're playing the infinite game and they can't deviate from that. Once they deviate from that, that's when they potentially, are going to have behaviors that contribute to losses being larger than they should and wins being smaller than they should. They continuously enter situations where they are risking small wins to hit home runs. And this is something that we'll talk a little bit more next week, which is, once you find yourself in a winning position, a lot of traders that are thinking about trading as wins and losses, what they do is they try to take profits quickly. Many times you take profits prior than what you originally planned on doing. Why do we do this? It's very easy to understand. As humans, when we see a win, it's incredibly painful if we see that win turn back into a loss, right? We were right, but because we didn't take profit, it ended up being a loss. That fear causes many of us to take profits earlier than we should. But if you look at the behaviors of successful traders, they do the exact opposite of that. They've trained themselves to kind of face that fear, to say, okay, I've got a small win in this trade. What that proves is that my thesis of whatever view I had when I entered this trade is proving to be correct, right? I think the stock's going to go up. It did go up. What do I do in that case? Do I take profits? No. What you do is you can potentially add more to that trade. Basically, you said, hey, I think the stock's going to go up, right? It did go up. So why should I take my profits now? Why don't I add some more and look for it to continue? Because if that trend does continue, that's my ability to turn a small win into a huge home run, even though I'm risking, that this turns around and I end up taking a small loss on the trade. So I basically turn a win back into a loss. And traders realize that that's worth taking on that risk, because it gives me that ability to hit home runs, right? I can really hit a home run if a trend really starts to run, and I can only capture that if I continue to hold on to my trade and potentially even add to my trade. Now, the adding to the trade is not always necessary, but it is something it's one of the tactics that successful traders will deploy to turn a small win into a home run, because you need home runs to offset consistent, a string of losing trades. And that's really kind of the mindset they have to be in terms of being a survivor, meaning you have to take risk when they present themselves, but you want to take the correct risk. You want to take the risks when the market proves that your thesis to be right. You don't want to take additional risks when the market proves you to be wrong, right? And that's when most of us do it, right? We think a stock is going to go up, but because it goes down, we end up adding to that position, thinking that if we just take on more risk, then hopefully it'll come back up and we'll get ourselves back to break even. But at this point, the market has already proven that your thesis is wrong. Why do you throw good money after bad money? Because again, we're human. That's what we do. And what we have to do is we have to change our behaviors and do the exact opposite of what we think we should be doing in order to get ourselves onto the path of profitability. So it's incredibly easy to create a trading plan. And almost everyone here has a trading plan, understands a trading plan. But what's very hard is your ability to stick to it. And that's because we're human. We make counterproductive decisions when we're placed under stress. That's something that that's been empirically studied over and over and over again, that human beings make the wrong decisions from a financial perspective when we're placed under stress. So what this course is really about is understanding those behaviors, understanding it's not really about why we do it, but just rather what we do, so that we have even the shot at fixing some of those behaviors and putting ourselves onto the path of profitability. Because if we don't fix those behaviors, if we don't have the right mindset, you're just going to keep repeating the cycle over and over and over again. Does that make sense, everyone? Please type 2 into the chat window if that makes sense to you. So like I said, out of all of this, right, I've sat up here, I've been talking for 45 minutes. The only thing that you really need to do after learning about all of this stuff is this one simple rule. Never exceed more than 1 to 2% of your total account value on any given trade if you are trading options. And one tool that we have built into OptionsPlay that allows you to do that is our risk and investment calculator. Now, many of you may have already used the risk and investment calculator in your portfolio. So I'm just going to show that to you real quick. When you're using the risk and investment calculator on OptionsPlay, no matter what option strategy you are looking at, whether you're looking at a bullish, bearish, long call, debit spread, credit spread, iron condor, straddle, strangle, doesn't matter. No matter what strategy you are thinking about trading, before you hit that trade button, use the risk and investment calculator that's at the bottom of your widget and click on calculate. Now, I have this already preset, and for those of you that have an OptionsPlay account, I'm sure many of you have already preset your amount, but if you have not done that yet, go to your profile, which is, you can either click on this button here at the bottom, or you can go into the hamburger menu on the upper right-hand corner where your name is. Go into your profile, and there is a risk and investment contract calculator. What this basically allows you to do is put 2 numbers. It defaults at 2%, but allows you to put in your portfolio value. So if, let's say, you have a $150,000 portfolio, you plug that in, it'll default to 2%, and what you do is you save this as default. And what that means is that every single time you look at placing a trade, use the risk and investment calculator, it will automatically calculate how much you can risk to stay within that 1 to 2% rule. And the only thing you have to do is click this calculate button once. Every single time you place this trade, you click that button once, it will calculate automatically for you how many contracts you can purchase. So if I think about buying this put debit spread, it's going to tell me I can buy 19 contracts of it. I don't have to do any math. It just automatically does it for me, where if I lose on this particular trade, my max risk is $2,907, which is just under the $3,000 limit that I've set for myself. And every single trade that I make, even if I'm looking at a trade with unlimited risk, I will still click on the trade button. I will still use the risk and investment calculator and know that I can sell 6 straddles on even though it has unlimited risk. It'll tell me basically if this trade goes, let's say, 2 standard deviations, if the trade goes 2 standard deviations higher, or if the trade goes 2 standard deviations lower, my total loss will not exceed the $3,000 that I've set for myself. So even with strategies with unlimited risk, it'll still try to help you calculate an appropriate number of contracts to trade so that you are doing it properly. Now, how many of you have set this setting in your portfolio already at an OptionsPlay, your risk and investment calculator? Okay, if you have, type yes into the chat window. Okay, I just see a lot of you who have. If you have not, if you said you have not set the setting, go into your profile right now, set it, just type in your portfolio value. You have to do it once. Obviously, if your portfolio value changes significantly, you have to go in there and change that. But set your portfolio value right now, because every single time you place a trade, you should get into the habit of using the risk and investment calculator, click on calculate, and know how many contracts you can buy or sell so that you stick to this 1 to 2% rule. Because out of all of the stuff that we talked about here today, that is the only thing that you have to take away from. That's the only thing you have to implement. Is this 1 to 2% rule. If you implement this 1 to 2% rule, you'll have a much easier chance of actually taking losses when you should be taking losses because you're risking a small percentage of your portfolio, and you will be able to survive those consecutive losses if you apply this rule each and every single time. Because what you're doing is you're basically saying, I'm not willing to risk losing my business or risking my marriage or blowing up my trading account on every single trade because I'm going to make sure that I try to survive and continue playing. That's what you're doing when you're sticking to the 1 to 2% rule. And if you don't do it, if you deviate from this, you're basically saying, hey, I'm willing to risk, I'm willing to put my business on the line. I'm willing to put my trading account on the line for this one trade. And if it doesn't go the direction I expect it to, I'm risking going out of business or I'm risking no longer being a trader. And guess what? I don't believe anyone should be doing that, because if you are doing it, at some point you will go out of business, and at some point you will blow up your trading account, and that you will end up back at square one. And that's what we're trying to prevent. We're trying to move you forward from square one, where many of you feel that you are stuck here today. Okay. So that covers what I wanted to share with you here today. Over the next two sessions, next one session, because we've already finished the last two sessions. I apologize. We learned about behavioral biases, and today we learned about risk management, which is really the loss side of things, right? Because we're playing an infinite game, our goal as an infinite game player is to stay in business, or in other words, avoid going out of business. And today we talked about how can we prevent ourselves from going out of business. The 1 to 2% rule is the golden rule. It is simple. There's only one rule. It's black and white. There's no ifs or buts, and it's really easy in theory to implement. What we're going to talk about next week is position sizing. And this is really where, or rather what we're going to be talking about is the winning side. So today we talked about what do you do if the trade's not going in the direction you expect to do. Next week, we're going to talk about what do you do if the trade does go in the direction you expect to do. And that's really where it's much more of an art than it is a science. Today, the loss side, very much a science, very math-based. There's no ifs or buts. When the trade goes in your favor, there are a lot of things that you can do. And there are a lot of things that you can do that contribute to hitting home runs. And that's what we're going to talk about, are some of those variations and how you can go about doing that. So today we talked about loss side. Next week, we're going to talk about the winning side. Everyone wants to talk about the winning side, and that's really where we should be focusing most of our energy on. You really should be focusing very little time on your losing trades, because if a trade is losing, you should cut it and let it go. And when you trade small, you're going to have a much easier time of letting go. There's no ifs or buts. When a trade goes in your favor, you have a lot of different options that you can now deploy. You can hold on to it, you can add to it, you can scale into it. There are so many different things that you can do. And that's what we're going to talk about next week. Because that is really where you should be focusing your attention on, because that is where you have the opportunity to start outperforming your portfolio. You can't really outperform with losses, right? The only thing you can do is keep your losses small, so that when the opportunity comes to hit a home run, you take that opportunity. And when you seize that opportunity, that is when you are going to be successful in the long run, because that's how your wins will actually start outweighing your losses. But you have to first keep your losses small to even have the opportunity where your wins are going to outweigh your losses. So it's a two-step process. Today, we talked about how to keep your losses small. Next, we're going to talk about how do you seize the opportunity to hit home runs and get yourself onto that path of profitability. So if you want access to today's recording, like I said, today's recording is that kind of light bulb moment, especially for those of you where the infinite versus finite game concept is new. There are many other areas where the finite versus infinite game is applicable to your life. Like I said, marriage, running a business, trading. These are all places where if you can think about that in a different way, you're going to have a much better outcome in those aspects of your life. So what I suggest that many of you do, if this is your first time learning this concept, is make sure that you take the time to watch that recording and think about what I've said today, because it's not something that's easy to internalize. It's very easy to understand the words, very difficult to kind of grasp that concept and actually start implementing it. So it takes time. So take the time to go through the recording, watch the slides, and make sure you set those settings in your OptionsPlay tool, because these are the most important tools that we have in our platform that help you stick with these specific rules. That's going to help you put yourself onto that path of profitability. So with that, what I'll do is I will open this up for Q&A. If you have any questions, there's a Q&A button at the bottom of your screen. I see many of you have already submitted questions there. I will answer questions out of the Q&A window, and I will try to answer as many questions as I have time for here today. Gordon, your comment on cash covered calls. The thing about a cover call is that it's technically a riskless strategy. You can't lose money from a cover call. You can lose money on the stock, obviously, but you can't lose money on the cover call, because if you've lost money on the short call, it means you've gained money on the stock. So I understand what you're saying, and I think what you're suggesting makes perfect sense. Do you hang on to loser till expiration date, or 3 weeks before expiration date? So from my perspective, losing should not have a time component to losing. Losing should always be a dollar amount focused decision. Meaning, if you risk $100 and you've lost $50 on it, once you've lost that $50 threshold, you should be cutting losses. Now, I'm giving you a one specific example, right, where you said you've planned, that I'm going to risk half of this trade. Once it reaches that trigger price, you should get out of it. You should not have a time-based losing or stop loss order. Your stop loss order should always be based on a dollar amount, because your portfolio is priced in dollars, right? You have a certain amount that you're willing to risk, and you better plan around that dollar amount rather than time. Yes. So, we'll send you the recording for the entire series, so that you'll get session 1, session 2, and then when we finish next week, you'll get session 3 as well. Greg's asking a great question. He's saying, why 7 losing trades? Why won't sometimes have 8 in a row, or 10, or 15 or 20? 7. I use 7 because your probability of having 7 losing trades in a row, let's say you make roughly 200 trades in a year. I'm going off of, a slightly higher than average. I think that the average of this cohort in terms of viewers is probably somewhere in the 150 trades a year. So I'm rounding it up to about 200 trades for the year. If you make 200 trades throughout the year, your chances of having 7 losing trades in a row is roughly 50%. Your chances of having 8 losing trades in a row is about 30%. Let's just call it 30%. So your chances of 9 losing trades in a row is probably closer to about 10%, right? So I chose 7 because it's basically a coin toss. Meaning in any given year, you probably have about a 50% chance that you're going to have 7 losing trades in a row if you're making roughly 200 trades throughout the year. Meaning, if you're making 200 trades out of the year, you have a 50-50 shot that at some point you're going to face 7 losing trades in a row. And my question to you is, does your risk management strategy today allow you to survive that? Because if it doesn't, meaning if 7 losing trades in a row is going to blow a huge hole in your portfolio where you're going to either lose confidence in your strategy, quit trading, or blow up your account, then guess what? You're not on your path to profitability. That's why I use 7. Could you use 8? Could you use 6? Yes, but I use 7 because it's about roughly 50-50 coin toss. 10, your chance of having 10 consecutive losing trades in a row on 200 trades is something like probably under 5%. Right, so that's why I'm not really looking at it, because 5% is 1 in 20 years you're going to come across 10 losing trades in a row. So 50-50 means once every 2 years, you're going to come across that. Can you survive that? If you can't survive that, you better be rethinking your risk management technique. 2% on any one trade, not per day, per trade, right? 2% per trade. So if you have a $10,000 account, every single trade that you place, if that trade goes 100% south, that trade should not risk more than $200. If you're risking more than $200, you're going to have trouble being consistent in the long run. How often will losses and wins come in clusters because we may have positions in multiple options? So okay, that's another good question, right? Because you can stick to this 1 to 2% rule and still blow up your account. How do you do it? By adding a lot of similar positions that are all 1 to 2%. What do I mean by that? Let's say you have a long position, 2%, you're risking 2% of your account position in NVIDIA, you have 2% of your account in AMD, 2% of your account in ASML, 2% of your account in Texas Instruments, 2% of your account in, I don't know, Intel. Well, now you don't really have a 2% position in semiconductors. You now have a 10% position in semiconductors, right? So in this particular case, if semiconductors goes in the opposite direction you expect it to, and you're all long position, you all have long positions in all these stocks, then you're really risking 10% of your time of your entire account because there's a very high correlation between all of these semiconductor stocks, right? So when we refer to 2% rule, we're generally talking about trades that have relatively low correlation or zero correlation. So, you have one airline, you have one semiconductor stock, you have a consumer discretionary stock, you have a technology stock, some long, some short, you can have 2%. But if you're all concentrated in one sector and they're all long, then you have to think about it in aggregate. So hopefully that answers your question. What about when you add into your already open position? Are you not going beyond 2%? You are going beyond 2%, but that is when it makes sense to go beyond 2% because you already have some profits to offset any further losses, right? So you're not just risking 2%. Your goal is still at the end of the day, after you add to a winning position, is that if that winning position then turns back into a loser, that you still end up taking losses at 2%. Right? But because the trade has gone in your favor, you now have some profits to buffer against taking on additional risk. So yes, your overall risk does increase when you do add on to an open position, but you're only adding to an open position when you have enough sizable profit to justify adding more exposure. Because at that point, you have profits to buffer against losses. So that if the trade does start to turn south, you can still get yourself out where you're risking 2%. Hopefully that answers your question. Can I do 5 trades at 1 to 2% at the same time? Absolutely. As long as those 5% are not all, like I said, concentrated in one sector and all long or all short. How do you choose the width of a credit or debit spread? So David, I actually have separate sessions on just teaching you, the mechanics of debit and credit spreads. You can find them on our YouTube channel. Philip, if you don't mind posting a link into the chat window with a link to our YouTube channel, just search debit or credit spreads in our YouTube channel. I have tons of videos on these. You can learn more about kind of the mechanics of those two strategies. A great question from Colin. Based on the 1 to 2% rule, is there a maximum number of open positions at a given time? I tend to find that the maximum number of open positions with the 1 to 2% rule tends to be about 10 open trades at a time. Once you go beyond 10, you're going to have some trades that are more correlated to others. Once you go beyond 10, it's going to be a little bit harder for you to manage those, day in and day out. So I generally find that 10 is a good rule of thumb in terms of number of open positions that you should have at the same time with regards to option strategies. Laura, you gave me a pretty long explanation. I definitely think that if you're risking 10% per trade, especially if they're options, you're going to have a tough time with this. And your comment about Simon Sinek writing a good book on infinite games is he is probably the most prominent speaker about infinite versus finite games in the applications in the business world. He talks about some of it in your personal world as well. But absolutely, for those of you that want to learn more about this, I'd suggest that you Google Infinite versus Finite Games by Simon Sinek on YouTube. There's some fantastic talks that he makes. Most of them is around running a business and how to apply this concept of running your business, but the same concept applies to trading. Greg, to answer your question, yes, you would need 50 open trades to utilize your full portfolio, but I do not recommend you to do that because that means that if you have one bad month, you can wipe out your entire portfolio. If only 2% on each position, does that mean you have to manage many open positions at one time? Yes, you do want to manage your many open positions at one time because you want to spread out your risk, right? If you have all of your trades in one position, you can't spread out your risk, right? That trade either works or it doesn't. And you could have a great month or you could have a terrible month. And you have no real way, you have no control over that. So that's why you always trade small. The width of a spread really is a factor on the stock price. The higher the stock price, the larger the width, the lower the stock price, the lower the width. Why don't I see an options play on the options chain on the trade screen? We purposely built this to avoid using the options chain. We built this tool so that you don't have to use an options chain to navigate. You can find the full chain by clicking on the modify button and seeing the different expiration dates and strike prices, but we basically built this specifically so that you don't have to look at the options chain because the options chain is just a lot of numbers, right? It's a lot of numbers, different strike price, different premiums, different deltas. What we do is we basically help you with the starting points. You don't have to use the options chain to figure out what expiration date, what strike price. We do that work for you. You just select whether you're bullish, whether you're bearish, whether you're looking to trade in high implied volatility environments like selling credit spreads or straddles. And we optimize the strategy based on the expiration date and strike price for you. And if you want to make modifications, you can. You can change the expiration dates by just clicking on a button here. You don't have to pull up an options chain to do it. You want to move all the strikes down one, you just click on a button to do it. You want to make it wider, you click on a button to do it. This way, it just makes it a lot easier for you to navigate the options chain rather than having to constantly go to an options chain, pick your strikes, then look at analytics, going back and forth, back and forth. All of the chain is available to you on your graphics so that you have a much more graphics view of, okay, instead of looking at the March ones, maybe if I pull up the April ones, what does it look like? What if I go up to the 490 strikes, or what if I go down to the 485 strikes? What is the price? You can see all of this P&L information. You can also use the P&L simulator and say, what happens if the stock goes higher? And I move the strikes higher. Like, what does that look like? You can do all of that using the P&L simulator and the visual tool rather than using an options chain. If you're accessing options play through Fidelity, then this is a separate service, right? What you're getting through Fidelity is only the service that you're getting through Fidelity. That is focused on helping you automate selling cover calls and cash secured puts. This is the options play platform. You can only subscribe this through optionsplay.com. So if you want to sign up for a free trial, you can click on that link that Philip posted into the chat window, optionsplay.com/sign up. That will give you access to this platform. You can try it out for free for 30 days, see how you like it, and decide whether it's something you want to add as well. A lot more comes with your OptionsPlay subscription with us. You get education, you get daily trading ideas emailed to you, a lot more things that come with this subscription than what you get through Fidelity. The probability of 7 consecutive losses. So yeah, you can actually model this. I actually built a spreadsheet that modeled, coin tosses, doing 200 coin tosses, doing it 1,000 times, and what are the times that over those 50 times you get those 7 consecutive heads or tails, and it comes out to about a little over 50% of the time that you're going to get 7 consecutive heads or tails. So you can build it from just like a heads or tails simulator. Basically flip a coin 200 times, and how many of those times will you have at least 7 heads or 7 tails in a row? That's kind of how we built those simulators. With that, that's all the time that I have here for today. I really hope that this is helpful for many of you who have spent the time to try to get yourself onto the path of profitability. I hope that this is illuminating for you in terms of what you need to be focusing your options, or rather your trading education on, if your goal is to reach profitability. Thank you so much. Have a great trading day, and I'll see you guys next Thursday when we will round out this education. Have a great trading day.